Hi everyone, and thanks so much for joining the July Payrolls Market Live special. So we will jump straight into charts because there is so much to discuss today. Great. Now this is my favorite page on Bloomberg, which I always start with. Let's start here. This is the World Equity Indices. Just follow my pointer here, but look at this, a whole sea of red. So there are two things driving markets today. Actually, it will be three soon. But the first thing is obviously the tariff news overnight. So Donald Trump pretty much gave a very broad swathe of tariffs to countries including Switzerland and Canada. They've now got the world's highest tariffs, followed by India, Indonesia, and Thailand. So it looks really like the UK, the EU, and Japan got off quite lightly. But there is now just a real big fear about a demand shock. So it's not causing massive repercussions. We're not seeing an April style sell-off, but nearly 2% down in the Euro stocks, over 2% down in the CAC, 1.8% down in the DAX index, and also a 0.5% decline in the FTSE. Relatively stable compared to other things. We've also got a big sell-off in pharma stocks. That's because we're still actually waiting for confirmation about pharma tariff rates, and Donald Trump is still going to needle pharmaceutical companies regardless of what happens, because he has said that he will he wants them to drop their drug prices in the US. So that's big news there. US futures expected to open very much lower, and we've also got kind of big moves elsewhere. I want to show you bond markets. Now bond yields have actually moved up. Now if I go on to the 2-year, let's see what's going on there. As you can see, US yields are a little bit of an outlier there because they're slightly lower. The latest thing Donald Trump has said, so overnight he came out with all the tariff rates, but the last thing he said is that the board of the Federal Reserve should take over the Federal Reserve, disband with Jerome Powell and cut rates urgently, because obviously the Federal Reserve did not do that on Wednesday night. Yes, there were two members who voted for a rate cut, but they were totally overruled by the other members. So there was no rate cut from the Federal Reserve, and there was no hint that there actually would be two rate cuts, which were expected for the rest of the year. And actually that was scaled back over the last couple of trading days. Now, obviously Donald Trump has run off about that, but the Fed's justification for being a little bit neutral and a bit hawkish when it comes to being very careful about rate cuts is down to tariffs and the fact that we don't know what the inflation outcome are. So as you can see, bond yields just ticking a little bit higher even as I'm talking here. So interestingly enough, before when I checked this, we had about 1.3 rate cuts expected by the end of the year. That's now risen to 1.7. So it does suggest that the market does react to what Donald Trump says, even if they don't actually believe that he's going to fire Trump. So whilst he's been trying to be quite he's had a bit of reconciliation with Jerome Powell over recent years, over recent weeks, which then eased fears that he was going to do something crazy like sack him and force the Federal Reserve to cut interest rates, which would be very, very bad for a leader of a democracy like America to do. It now looks like he's kind of putting the pressure back on. So that's something to point out there. Now, I do want to show you the dollar index. Now, the dollar is the second strongest currency in the G10 FX space today. It's also been on a bit of a tear higher. It's the best performing, it was the best performing currency in the G10 in July as well. So we've seen this real, as you can see, weakness in the dollar. This is the dollar index, of course, which is the dollar versus its broad trading partners. It's now rising. So it suggests that the reality of tariffs is not bad for the dollar. The dollar index has sliced through that 50-day moving average, which came in at 98.30. It's also sliced through the 100-day moving average, which came in at 99.7, just under 99.80. It's now above 100, kind of moving sideways along there. We've obviously got to see what's going to happen with payrolls, and we'll talk about that in a moment. But by and large, this suggests momentum is building on the upside for the US dollar. And that what we're seeing with tariffs is good news for the dollar. Now, I want to show you this chart because I think this is just a really good way of showing you the dollar strength and where the weakness is in the FX market at the moment. So you've got, this means that basically all the G10 currencies are weak against the US dollar since the start of July. The yen and the pound are the weakest. We know that the pound has had some real problems. We know also that the yen obviously has been weakening as well. So they've dropped 4.74 and 4.31%, sorry, just in the past 4 weeks. That is a huge move. The euro is down 3.5%. The Swiss franc is down 3% versus the US dollar. So there's been a real shift out of the G10 currencies and back into the dollar. That suggests that there's a bit more expectation, I think, is that, and that's also married up very well with US stock markets doing so well. So let me just put up the S&P 500 index, obviously giving you a broad overview of all the US currency, of all the US, of the main US stocks, main blue chip US stocks. Again, like, it's just such a beautiful uptrend there. We've seen that big that big move higher there in stocks on Thursday. Remember, US markets aren't quite open yet. They open in an hour, just over an hour. So we've seen that big move higher. We've gone above. We closed around about that 6,000, just below that 6,400. 400 might say, well, sorry, not just below the 6,350 mark there, just at 6,340. So 6,400, we have tested the air up there. That's really interesting. Obviously, fresh record high yesterday as well in US stocks. That came after better than expected Apple results. Amazon was a bit of a drag on the index, however. But today it is expected to pull back below there. But it does look, since we broke above that 6,000 level, we are looking very comfortable above it. And it's been a good summer for US equities. So we are seeing some movement there on the downside as we lead up to these payrolls reports. So if I just put up this, so 104,000 is what the market is looking for, but there is a really wide range in payrolls for July. So it ranges from estimates of 0 to 170. Typically, when we see that kind of huge variation in economist estimates, it means, well, no one has a clue what is actually going on. And it also means that we could really get anything coming out of this report. So a big surprise one way or the other would not be unexpected, if you see what I mean. The whisper number is that this could be the lowest payrolls reading of the year so far. Private sector payrolls are actually expected to pick up a touch to 100K. No manufacturing jobs though, because obviously all this tariff uncertainty, economic uncertainty, getting used to a new normal, is going to play out in the labour market, and it's going to take a while for that to play in. Now, just a few other points to note. Unemployment rate expected to edge up to 4.2%. If we were to see a bigger move, say 4.3, 4.4, that will really worry people. Now, I don't think that will happen because the participation rate is still quite tight. So we don't expect a big move higher, just a notch higher in the unemployment rate there. And then we've got the hourly earnings, so the wage data as well. That's also expected to just edge up slightly to 3.8% from 3.7%. Let's just take a quick, let's zoom into that dollar to see what that dollar index is doing as we move through this day. So as you can see, it's kind of trading sideways. So we've backed away from the high of the day so far, but it's trading around about just below that 100.20 level. So that's worth watching. Let's just take another quick look at stocks. So yeah, they're kind of in a holding pattern, not seeing too much movement now, but I'll take you as well. This week has been quite negative for stocks. Yes, we've got some upside, very small move higher so far in the past week for the NASDAQ. S&P 500 slightly lower, but look at these big losses here for some of the European indices, with the FTSE being the most resilient. So it looks like the UK and the FTSE, the US stocks FTSE doing quite well, but 2.45% loss for the Euro Stocks 50 index, 2.84% loss for the CAC, 2.43% loss this week for the DAX. That's what we're on track for at the moment. So certainly worth watching. Dollar not making too much of a move. I'm going to show you dollar yen as well, because that's always interesting. And I'll also show you dollar Swissy, because that's been very interesting today. The dollar yen has it's picked up off its lows. So maybe that's a sign that it's not going to be as weak as expected. And then Swiss franc as well. Let's pull that up. But let's go straight back. Let's see how long we've got. Okay, just under 30 seconds now before we get, 30 seconds now before we get the non-farm payroll. So 104 is the number, but I have heard the whisper amongst analysts and kind of on the street is that it's going to be a weaker number. But to be honest, expectations are really all over the place at the moment. Markets and analysts, they just don't know where the economy is. So far, the economy has been very resilient. So we would, if we're going to see that strength in the stock market, that strength in the dollar in particular, then we need to see a strong labour market report. A really weak data, I'm expecting the dollar to fall. But let's take a look at what happens any minute now. 73, so it is weaker. So that is at the weaker end, a slightly weaker as well in terms of the private sector payrolls, and manufacturing payrolls have turned negative. Let's take a look at that. So yes, the unemployment rate ticked up to 4.2%. 4.2, and we saw stronger than expected wage growth, 3.9%. That is very, very interesting. So it suggests that we could be, it's not quite stagflationary, but this is a weak jobs number. Let's just go into that just to analyze that a little bit more, because it is a bit weaker than expected. I'd sort of bring it up, see where we are with it. What does this 74 payrolls mean? Let me just bring it up like this. So we did see we saw a bit of craziness, didn't we, at the start of this year? So it is the lowest of the year so far. That 111, 102 in January and February was seen as being a bit of anomalies because of that. So it really is, if we strip out January and February, it's going back to kind of some of the weakest levels since October. We have seen some periods of weaker job data, and then it comes bounding back. So that is something to point out. But we had been pretty steady, 120, 158, 144, 147. So a weaker number. That word on the street was correct, obviously. Let's take a quick look at what's going on. 10-year yields, they are falling really sharply. So they are down some 8 basis points on the back of this, and extending downside as well. Let's take a look at the dollar. Doesn't really know what to do. We might be having a bit of a delayed reaction in the dollar, so we're going to watch that. Dollar yen fallen quite sharply, now back below 150, currently trading 149.60. So a big move, 100 pip move there in dollar yen. And let's look at Swissy. Yeah, dollar Swiss has fallen back quite sharply as well. So that had been at 81.70. It's currently trading about 81. So about a 70 pip drop there in dollar Swissy as well. So we would expect it's going to be a bit too early to see this in the data. But if I just take a look at 0731, so the daily bit, yeah, so it has shown up right now. Everything, the dollar is now the weakest currency in the G10 FX space, and everything has turned around and is stronger against it in the immediate aftermath of that payrolls report. Let's just dig in a little bit deeper just to see if there's any trends or anything that we can actually look at to see what happened here. This is the June reading, so actually that doesn't tell us anything. Sorry, that hasn't quite been updated yet. I'm sure that will very soon. But the unemployment rate as well, ticking up to 4.2%. Let's take a look at when that was last at 4.2%. Because I reckon that was a quite a big move. So obviously we had, so actually 4.2% is kind of the average of the year so far. So nothing really to worry about there, but what a big kind of change it has been. We're now very much in that 4 handle. And then obviously wage growth as well is something to watch out for. So let's just, we'll just chart this unemployment rate. So it is steadily moving higher, but it's still very low at a historical level. Let's see if they have updated everything. So we can actually see what was the strength, what was the weakness. And the net change. Okay, here we go. So June data. We got a bit more on the downside, I guess. We got some strong, oh no, sorry, this is, let me just double check what this is, just so that we're looking at the right thing. I definitely don't want to confuse anyone. Change in non-farm payrolls. Oh, and a big revision down actually for the June data as well. So actually June data was very weak, came in at 14,000. So we saw a bit of a pickup. That is interesting to know as well. Let's just take a quick look to see what that is doing. Payroll, this is 10-year bond yields. They're still on the downside. Take a quick look at the dollar index. It doesn't quite know what to do yet, but it is going to fall. Dollar yen extending downside there, and the Swiss franc also extending downside. So at the lows of the day on the back of this report. Let's take a look at where things picked up. So big revision lower for June, actually. That's why I wanted to check that, because it didn't look quite right. But 14K for June, my goodness, we are in a maybe a bit of a jobs recession in the US. The most jobs were created yet again in education and health services. That was the same in June. Now it's the same in July. Little bit of employment created in other services. Some real weakness, though, in government. Government jobs fell, even without Elon Musk there, slashing budgets left, right, and center. Professional and business services as well. And that would be interesting to see if there's any AI linked towards that. And then also with, what's this? Information, again, is that an AI link? So is this going to be a bit of a trend with our obsession with AI? Is it now starting to feed through to slightly bits or right now it's a tiny drag on payrolls, but will it be a bigger drag? The fact that the government didn't pick up, jobs there didn't pick up either, is really worth noting. But this is definitely a very, very weak payrolls number, and we can see that with all our data, with all what the FX market is doing, what the bond yield market is doing, and also, of course, with what stocks will most likely. It will be quite interesting what happens with stocks. So stocks have extended the decline in Europe. So we're now like trading down 2.2% for the CAC, 2% for the Euro stocks. So down about an extra tenth since this report. Obviously, US markets aren't open yet, so we're going to track them quite closely. On the one hand, a weaker economy and a weaker jobs market doesn't bode well, right? Because a weaker economy could be weaker profits down the line for all these companies that are on the Dow, the S&P 500 and the NASDAQ. But on the other hand, it does make it more likely that there will be some rate cuts from the Federal Reserve. So there is a silver lining. So we don't expect stocks to just fall off a cliff. Right now, European markets have just reacted, very knee-jerk reaction to that tariff news that we heard overnight. But we really want to see what the US does. And it'll be interesting to see if the US does extend those declines, because that narrative has been punctured that the US economy is very resilient to everything that's going on in the world. Maybe it's not so resilient is what this data is telling us. And there might be a bit more pressure on Jerome Powell after this data now. We could hear more from Donald Trump, really pressuring him into cutting interest rates. So maybe let's just take a look at where we are with interest rate cut expectations. There's only a 42% chance of a rate cut from the US in September. Now that had been as high as 60% only a few weeks ago. So after we got a torrent of slightly stronger data, we could see that rise up a little bit. So without a doubt, labour market is weakening. But watch out for that. Again, it's not clear cut anything at the moment, because look at this. The hourly earnings up to 3.9%. So, well, is that the highest since? Obviously, hourly earnings has been trending down a little bit over the last couple of years, but it seems to have kind of plateaued there. Will that deter them? Because it is above the 2% target rate for the Federal Reserve. So that is something to watch out for. So overall, a very, very mixed report, but I think it's weak. On balance, it's very weak. But there are some kind of little bits in there, like the stronger employment data, which just makes it a little bit harder to actually read. And as I mentioned, European markets are just weakening. They're just falling on the back of this, but they will actually take their real movement from what the US does when it opens later today. Let's take another look. So, bouncing around all over the place here. Yes, we've continued to extend on the downside here with bond yields. So they had been as high as 4.4 today. They're now down at 4.28. So a 12 basis point drop there. For the 10-year US Treasury yield. We are extending declines there for the dollar yen as well. So it looks like we've made quite a big move lower. We had been as high as 150.90, so just below 151. We're now currently trading at 149.20. So that is a very big move and very big reversal. So all those dollar longs that were out there earlier today, they have been reversed very, very quickly. And then the Swissy, as I mentioned, Switzerland got really hit hard with the tariffs. That really eroded demand for the Swiss franc, but that is coming back now as well. Those people that were saying that the Swiss franc is not a safe haven, maybe they need to reassert and not be too quick, because you often get this whipsaw action. But right now, there doesn't seem to be much whipsawing back. It just seems to be all on the downside with dollar yen, as you can see here, falling off dollar Swissy, falling off a cliff. Let's just zoom out so we can put that into some context, that move. As you can see, it's a pretty big move, actually. We had a pretty solid uptrend there, going back to the highs since the end of June, and we've now reversed part of that move. So definitely something to watch. And this is a really interesting report, I think, because it really shows that the US economy, the narrative that we had has been punctured that the US economy is doing really, really well. This is a weak payrolls report. I don't think there's any doubt about it. Healthcare and education, that's been creating jobs for quite a while. But the fact that services, professional services jobs, government jobs, they're still being cut. They were actually cut last month, is a real concern. And also that June revision down to a very low number. So definitely something to watch out there. But yeah, weakness in the dollar across the board, and we expect stocks to really set the tone in the US, but European stocks very also weakening on the back of that non-farm payrolls data. So thanks so much for joining, everyone, and we hope to see you soon.